Welcome back to the Deep Dive. It is Monday, January 26, 2026. If you have been watching the markets today, you probably feel a little bit like you're standing on the beach watching the tide go out just before a tsunami hits. There are days when the financial news is just background noise, white noise, and then there are days when the tectonic plates actually shift beneath our feet. Today is absolutely one of those shifting days. The Capitol Dam has officially broken for USA rare earth, ticker symbol USR.
It really has. And, we talk about paradigm shifts a lot in this industry, probably too much, but this feels like the real deal. For the last 3 or 4 years, whenever we looked at this company, or really the entire domestic critical minerals sector in the United States, the conversation always hit a brick wall. And that wall was a simple, nagging question.
Can they actually fund it?
Exactly. Can they fund it? It's the classic problem, right? I mean, it's one thing to have a mountain full of rocks in Texas that you claim are valuable. It is an entirely different beast to have the billions of dollars needed to turn that rock into a magnet that goes into a fighter jet or a Tesla.
Precisely. It's the difference between a science project and a viable business. For the longest time, USR was hovering in that promising but unfunded purgatory. They had the geology, they had the plans, but they didn't have the checkbook. But as of this morning, that question, can they fund it, is dead. It is buried.
Yeah.
Because they just announced a staggering $3.1 billion financing injection.
$3.1 billion. That is a number that makes your eyes water a little bit.
It's massive. And to put it in perspective, that is enough capital to fundamentally transform the company's identity overnight.
Mm-hmm.
We weren't talking about a credit line just to keep the lights on or, pay the janitor. We're talking about the White House and major institutional money stepping in simultaneously. So the question for our deep dive today changes completely. It's no longer can they fund it, it is now can they build it? Which, to be fair, is a much more exciting problem to have, but also a much more complex one. And look, we are going to unpack all of this, the money, the mine, the factory, the intense politics behind it. But I want to give you, the listener, a little tease of where we are headed, because the destination here is fascinating. By the time we get to the end of this hour, we are going to see why this isn't really a mining story anymore. If you're looking at this as just digging dirt out of the ground, you are missing the point.
I completely agree. What we are witnessing today is effectively the birth of a state-backed industrial utility. This is about infrastructure. It's about national security. And when you run the numbers, which we will do in detail, you start to see a potential intrinsic value that sits somewhere between, say, $35 and $45 per share, which is a significant jump from where we've been.
That is a bold number. So our mission today is simple. We are going to do a Buffett-style analysis. We are going to strip away the hype, ignore the flashing lights on the ticker for a second, and look at the business model, the people running it, and the cold, hard cash that is now backing it up. We have a massive amount of ground to cover, so let's get right into the structure of the show.
Part 1, Chapters 1 to 3, Business, Management, and Financials.
Chapter 1, Business Understanding. Okay, let's unpack this financing because the headline number is $3.1 billion, but I feel like the devil, and honestly, the delight, is in the details here. This isn't just one big check from a single benefactor, is it? It's a very specific, engineered combination of capital.
It is, and I would go as far as to call it a deus ex machina moment for the company. It's a two-pronged attack on their balance sheet issues. First, and arguably most importantly, you have the government side. USA Rare Earth has entered into a letter of intent, or LOI, with the U.S. Department of Commerce. This falls under the CHIPS and Science Act. We are talking about up to $1.6 billion in total government funding.
Hold on, I want to pause there because I think a lot of people hear CHIPS Act, and they think strictly about semiconductors. They think about silicon wafers, NVIDIA, Intel, that sort of thing. Why is a mining company getting CHIPS Act money?
That is a key realization to make. The CHIPS Act isn't just about the final processor. It is about the entire supply chain. You cannot have a high-tech economy, you cannot have advanced computing or guidance systems without the raw materials that go into them. The Department of Commerce is realizing that building chip fabs in Arizona is, well, it's useless if the materials to make the chips and the motors that use the chips are stuck in China. So this $1.6 billion is a recognition of that reality.
Okay, so it's supply chain security. How is that $1.6 billion broken down? Is it a loan? Is it a gift?
It's a mix, and it's a very favorable one. You have $277 million in direct grants.
Okay, so that's just free money.
That is essentially free money. It's non-dilutive capital that goes straight onto the balance sheet. They don't have to pay it back. They don't have to give up shares for it. It's a grant. And then you have a $1.3 billion senior secured loan facility.
When you say loan facility in this context, are we talking about high interest rates? Because
Hmm.
usually a pre-revenue mining company would be paying, loan shark rates in the private market.
Oh, absolutely. If they went to the junk bond market, they'd be paying double-digit interest, probably 12%, 14%, maybe more, with all sorts of nasty covenants attached. This government loan is going to be significantly lower interest. It's concessionary capital. This is the government stepping in to provide cheap capital to de-risk the project. But, and here's the kicker, the government money doesn't flow unless there is private skin in the game. They aren't going to fund the whole thing alone. That's where the second prong comes in.
The private capital, the match, so to speak.
Right. Simultaneously, to unlock that government money, they announced a $1.5 billion PIPE. That stands for Private Investment in Public Equity. This is anchored by Inflection Point and other big institutional investors. And here's what really caught my eye and what should catch the eye of any investor listening. It was priced at $21.50 per share.
Walk me through why that price matters. Because usually when companies raise this kind of massive cash, don't they have to offer a discount? Usually the narrative is, hey, we're desperate for cash, our stock is at $20, but if you give us $1 billion, we'll sell it to you for $15.
You are spot on. That is the standard death spiral financing for miners. It crushes the existing shareholders. But this was the opposite. The stock closed around $24.77 on Friday, sure, but this deal was likely negotiated over weeks when the stock might have been lower or more volatile. The fact that these institutional giants agreed to pay $21.50 a robust price shows immense conviction. They weren't looking for a bargain bin deal. They were looking for a seat at the table. Pricing it at $21.50 ensures they have a cash equity required to unlock that massive government loan. It's essentially a key that opens the Treasury door.
And the market reaction was explosive. Looking at the charts today, the stock jumped from around $24 to hit highs of $40.02. The volume is absolutely wild. Over 70 million shares traded today compared to their average of 18 million. That tells me this isn't just retail traders having fun. This is institutional rotation.
The capital dam has broken.
Oh,
That metaphor works because for years, capital was holding back, waiting to see if the government would actually step up. Now that the check is signed, the water is rushing in, the market is realizing that the risk of bankruptcy or the risk of endless dilution just to keep the lights on is effectively gone. Now they have the war chest.
So they have the money. That's step one. Now let's talk about what they're actually doing with it, because you mentioned earlier that this isn't just a mining story. They have this strategy they call mine to magnet. Vertical integration is a buzzword we hear a lot, but in this specific industry, does it actually matter?
It matters more here than almost anywhere else. This is the core of the investment thesis. Historically, the rare earth industry outside of China is incredibly fragmented and inefficient. You have miners who dig up the rock, essentially selling specialized dirt, and they produce a concentrate. Then they have to ship that concentrate to a refiner, usually in China. The refiner sells oxides to a metal maker, usually in China. The metal maker sells alloys to a magnet maker, almost always in China.
I'm sensing a geographic theme here.
The theme is that Western miners are price takers. They sell a commodity and have zero control over the finished product. If China decides to lower the price of concentrate, the miner goes bust, while the magnet maker in Shanghai is doing just fine. USAR is doing something different.
Yeah.
They are vertically integrating the whole chain. They are closing the loop.
So they control everything from the dirt in the ground to the finished magnet that goes into the motor.
Exactly. It's 3 distinct stages, all under one corporate umbrella. Upstream, you have the mining at Round Top in Texas. Midstream, they are processing that rock into separated rare earth oxides right there on site. They aren't shipping dirt across the ocean. And downstream, and this is the key differentiator, they are taking those oxides to their own factory in Stillwater, Oklahoma, and manufacturing the metals and the magnets themselves.
So they aren't selling dirt, they are selling a high-spec engineered product.
Yeah.
That has to change the economics, right?
It changes everything. They are capturing the margin at every single step of the value chain. A permanent magnet for an EV motor or a missile guidance system isn't a commodity like copper or wheat, it's a piece of technology. It commands a premium. By controlling that final step, they transform from a mining company into a specialty chemicals and industrial manufacturer. That's a much stickier, much more profitable business to be in.
Let's go back to the source of all this, though. The rock itself. Round Top Mountain in Texas. I've done a bit of reading on this, and geologists seem to get into fights about carbonatite versus rhyolite. Most of the famous mines are carbonatite. Round Top is rhyolite. Why should a regular investor care about the type of rock?
It matters because of geology and chemistry, which ultimately dictates cost. Most rare earth mines, like MP materials in California, are carbonatites. Those are great deposits, very high grade, but they are mostly light rare earths, like neodymium. Round Top is a rhyolite deposit. The minerals are hosted in something called ultrafluorite, which is chemically very distinct. The magic trick here is that ultrafluorite is soluble in dilute sulfuric acid.
Okay, flashback to high school chemistry. Why is solubility in acid a good thing for a miner?
Because it allows them to use a process called heap leaching. Picture this. Instead of building a massive factory to grind rocks into dust and float them in giant tanks of chemicals, which is expensive and energy intensive, they just crush the rock into gravel, stack it up on a giant lined pad, and just trickle acid over it. It's almost like a massive drip coffee machine, but instead of coffee, you get pregnant solution full of rare earths.
That sounds suspiciously simple. Is it really just dripping acid on rocks?
In theory, yes. It is significantly lower on the capital intensity curve. You avoid the massive grinding mills, you avoid the flotation circuits, but the real moat at Round Top isn't just how they get the metal out, it's what metals are in there. It is exceptionally rich in heavy rare earths, specifically dysprosium and terbium.
The spice metals.
We call them that because you only need a sprinkle of them, but they are absolutely essential. Standard magnets, neodymium magnets, lose their magnetism if they get too hot. Say, inside an electric vehicle motor spinning at 10,000 RPM. If you add dysprosium and terbium, the magnet can handle temperatures up to 200 degrees C.
So if you want a high-performance EV or a drone that doesn't fall out of the sky when the engine gets hot, you need these heavy rare earths.
You absolutely do. There is no commercial substitute right now, and here's the scary part. Right now, almost all of the heavy rare earths come from ionic clays in southern China and Myanmar. Round Top is one of the few large-scale sources of these elements on the planet that is outside of Chinese control.
And it's not just rare earths, right?
Oh.
I read that it's a polymetallic bonanza. That sounds like marketing speak. But what else is in there?
That's the other beautiful thing about this geology. It's not just one thing. It's full of lithium, gallium, and beryllium. In a Buffett-style analysis, we look at these co-products as a natural hedge. They can sell the lithium and gallium, and the revenue from those sales could theoretically pay for the entire operating cost of the mine.
Wait, so if the lithium pays the bills, the rare earths are free?
Effectively, yes, that is the goal. If the co-product credits cover the OPEX operating expenses, your cost of production for the main product drops to near zero, or could even be negative. That makes you incredibly resilient. If rare earth prices crash, you don't care because you're making money on lithium. If lithium crashes, you rely on the gallium. It's a diversified portfolio within a single mountain.
Let's move downstream to Oklahoma, the factory in Stillwater. We talk about building supply chains, but is this actually happening, or is it just a blueprint in a PowerPoint deck?
It is very real. This isn't concept art. The facility is scheduled for commissioning in the first half of this year, 2026. They are aiming for an initial output of 5,000 metric tons of magnets per year.
5,000 tons. Is that a lot? It sounds heavy, but in the grand scheme of things.
It's significant. It's enough for millions of electric vehicles or thousands of cruise missiles. It moves the needle for U.S. national security. And they plan to scale that to 10,000 tons. Plus, they aren't just staying in the U.S., they are expanding into France via their subsidiary, Less Common Metals, or LCM. They're building a global footprint to supply NATO allies, essentially.
And the timing seems impeccable because the geopolitical situation, the macro context, has really heated up. I mean, we are fully in a Cold War over minerals at this point, aren't we?
We are. Historians might look back at late 2025 as the turning point. That was when China imposed strict export controls on processing technology and magnets. That was a Sputnik moment for the West. The realization hit Washington and Brussels hard. We can't build F-35s if Beijing turns off the tap.
Yeah.
It wasn't theoretical anymore. It was happening.
And the U.S. response has been aggressive. It feels like the era of free trade in minerals is just over.
It is over. As of January 1st, 2026, there is a 25% tariff on Chinese magnets. This is huge for USR. It creates a pricing umbrella. A Chinese competitor has to be 25% cheaper just to compete with USR in the American market. That protects USR's margins. And then you have President Trump's executive order from January 14 creating a demand floor. The government is basically saying, we will buy this stuff if the market won't. They are de-risking the demand side just as they de-risked the financial side.
So you have the money, the mine, the factory, and the government protection. It sounds perfect on paper, but companies are run by people, not paper. Let's talk about who's actually driving the bus. Chapter 2, Management Evaluation. Management is everything in these types of projects. I've seen great assets ruined by bad management. USAR made a very interesting pivot back in late 2025. They brought in a new CEO, Barbara Humpton. Now, I looked her up. She's not a miner. She's not a geologist. She doesn't have dirt under her fingernails.
And that's what I find so compelling about this appointment. She is the former CEO of Siemens USA. If you know Siemens, you know they are giants in industrial automation, digital twins, and supply chain digitization. They build the factories that build the world.
Why does a mining company need a Siemens executive? Wouldn't you want someone who knows how to blast rock?
Because USR isn't just a mining company anymore, we established that. They are building a complex chemical processing plant and a high-tech manufacturing facility. Explorers and geologists are great at finding rocks, they are treasure hunters, but they are often terrible at running strict Six Sigma manufacturing operations. Humpton brings that Fortune 500 rigor. She knows government contracting, which is now their lifeblood. She knows how to build digital simulations of factories, those digital twins, to optimize them before they are even built. It signals that the company is shifting its identity from exploration to execution.
It's a signal to the market that they are serious about the industrial side. Now let's talk about how they handle money. We mentioned the dilution earlier, the pain of issuing shares. A lot of existing shareholders probably grumbled when they saw 70 million new shares or whatever the number is hitting the market. How do you evaluate that choice?
I think they made the hard, correct choice. Management chose pain once to get certainty forever. Raising $1.5 billion via the PIPE meant diluting existing shareholders significantly. Your slice of the pie got smaller. But in this industry, cash is oxygen. If you starve the project, it dies, and your slice of the pie is worth zero. By ripping the Band-Aid off and raising all the money at once, at a premium no less, they eliminated the overhang.
So they chose a smaller slice of a guaranteed pie rather than a big slice of a maybe pie.
Exactly. And the government loan plays into this efficiency, too. That $1.3 billion from the Shiji Peace Act is likely at a concessionary interest rate. If they had to go to the junk bond market, they'd be paying massive interest payments that would bleed the company dry before they sold a single magnet. This lowers their cost of capital dramatically. Every dollar they save in interest is a dollar that falls to the bottom line later.
And they haven't just been building from scratch, they've been buying, too. You mentioned less common metals, LCM, earlier.
What?
Why buy a company in the UK, France?
That was a smart M&A move. Making rare earth alloys is actually incredibly difficult metallurgy. It's like baking a souffle. If you get the temperature wrong by a degree, it's ruined. Instead of spending 5 years trying to figure out the recipe and failing, they just bought a company that was already doing it successfully. LCM was already a qualified supplier to Western supply chains. It leapfrogged years of R&D. It's a classic buy versus build decision, and they chase speed.
And finally, on management, we have to talk about the alignment with the government. The Department of Commerce isn't just a lender. They are taking equity. That feels weird to me. The government owns shares.
It is weird for the U.S., but it's becoming the new normal for strategic assets. The Dept of Commerce is taking a roughly 10% equity stake through shares and warrants. This is crucial. The regulator is now a shareholder. Think about the incentives. If the EPA or another agency wants to put up a roadblock, or if a local permit gets stuck, they are now blocking a project that the Commerce Department owns a piece of. It aligns the whole machinery of government behind the success of USR.
That is a powerful partner to have. It's like having the referee on your team. Okay, we've talked about the big $3.1 billion number, but let's look closer at the financial health of the company now that the check is cleared. Chapter 3. Financial health. We threw around the term fortress balance sheet in the intro. That's a term Jamie Dimon uses for JP Morgan. What does a fortress balance sheet look like for a mining startup?
It looks like a transformation from a pauper to a prince. Before today, they were burning cash. With maybe a year of runway left, they were living paycheck to paycheck. Now let's add it up. They have their existing cash, plus the $1.5 billion PIPE, plus the $277 million in grants, plus the $1.3 billion loan availability. Total liquidity is roughly $3.4 billion.
That is a staggering amount of money for a company this size. It's almost hard to wrap your head around.
It is. It means they can build the mine in Texas, the processing plant, and the factory in Oklahoma simultaneously. They don't have to stage it. They don't have to build the mine, wait for revenue, and then build the factory 5 years later. They can parallel process everything. They don't have to stop and ask Wall Street for more allowance money. They are fully funded to production.
But with all that new money came new shares. We need to talk about the valuation. The pie got bigger, but there were more slices. What is the new math?
So, because of the PIPE and the government warrants, the share count has gone up. The fully diluted share count is now approximately 200.9 million shares. With the stock trading around $33.58 where we saw it today, the market cap is roughly $6.75 billion.
$6.75 billion. That sounds expensive for a company that isn't selling much yet.
It puts them in the mid-cap tier, sure, but you have to look at what they're going to earn. You buy a stock for future earnings, not past performance. Let's project out to a steady state around 2030. If they sell 10,000 tons of magnets at a conservative price of $120 per kilogram...
Is $120 conservative?
For high-performance dysprosium-rich magnets, yes. These aren't refrigerator magnets. So 10,000 tons times $120,000 per ton. That's $1.2 billion in revenue just from magnets. Then add another $200 million or so from selling the lithium and gallium co-products. You are looking at $1.4 billion in annual revenue.
And the margins?
Integrated producers usually command high margins. If they hit a 35% profit margin, which is standard for this type of specialty chemical manufacturing, that's nearly $490 million in EBITDA. That's earnings before interest, taxes, depreciation, and amortization.
And how do you value that $490 million?
Well, defense contractors and high-tech suppliers often trade at a 20x multiple of EBITDA. They get a premium for stability. So 20 times $490 million is roughly a $9.8 billion enterprise value.
And they're trading at $6.75 billion now. So even after this massive run-up, there is theoretically another 40–50% upside just to get to fair value.
Exactly. The market is pricing in a lot of success already. It's not cheap in the traditional sense of a bargain bin stock. But the margin of safety here isn't a low PE ratio, it's the government put. The United States cannot let this fail. The downside is capped because USAR is now critical infrastructure.
And the burn rate. They are spending money to build this, but are they safe for now?
They are losing about $60 million a year in operating costs right now. But with a $3 billion war chest, that is a drop in the bucket. They can sustain that burn for decades if they had to. The financial anxiety, the existential dread of running out of cash is gone.
That wraps up part one. We have looked at the business mechanics, the team leading the charge, and the massive bank account backing them. But how is the market reacting to all this news, and who actually owns this thing now? Let's move to part two.
Part 2, chapters 4 to 7, market sentiment, ownership, risk, and final conclusion.
Chapter 4, market sentiment. You mentioned earlier that the stock went parabolic today. It shot up like a rocket. Let's talk about the short squeeze, because there were a lot of people betting against this company, weren't there?
Oh, absolutely. The short interest was high. Before this news broke, about 16.6% of the available shares were sold short. That is a very high number for a company like this.
For listeners who don't trade, could you explain what those short sellers were betting on? What was their thesis?
Their thesis was simple. USR is running out of money. The government is slow. They will have to do a desperate equity raise to survive. They thought USR would have to sell stock at $10 or $15 just to keep the lights on. The shorts planned to buy the stock back at those low prices, return the borrowed shares, and pocket the difference.
And instead, the company raised money at $21.50 plus free government cash.
Exactly. It was a classic bear trap. The capital dam broke and the shorts were swept away. Suddenly the stock isn't going to $10, it's going to $40. They are losing massive amounts of money every second the market is open. They are now forced to buy stock at $30, $35, $40 just to close out their losing positions. That buying pressure fuels the rally even more. It's a feedback loop.
But beyond the technical squeeze, which is a short-term phenomenon, there's a narrative shift happening, isn't there?
Yeah.
People aren't talking about USR like a mining stock anymore.
No, the conversation has fundamentally changed. Investors are realizing this isn't a speculative miner where you drill holes and hope for the best. It's becoming defense infrastructure. They're starting to compare USR to companies like Lockheed Martin or Northrop Grumman.
That's a big upgrade in prestige.
It is. Those companies get higher valuations because their revenue is backed by the government. It's safer. It's predictable.
It's the patriotic trade.
It really is. There is a social buzz around investing in American independence. People want to own a piece of the supply chain that breaks reliance on China. It's a powerful story, and stories drive stock prices.
Looking at the charts, let's do a little technical analysis. What are you seeing? Is it too hot?
Well, the breakout is clear. It's smashed through the $25 resistance level like it wasn't even there. But the RSI, the Relative Strength Index, is screaming, overbought. It's very hot right now. I wouldn't be surprised to see it cool off a bit in the short term as the traders take profits.
Where is the floor? If it drops, where does it stop?
The new line in the sand is $21.50. That's the PI-PE price. That is where the big institutional money came in. They will likely defend that level aggressively, and analysts are going to have to update their models. The old price targets of $26 are obsolete. I expect to see Wall Street targets moving to the $40 to $50 range very soon.
So the sentiment is bullish, the shorts are running for cover, and the chart looks like a hockey stick. Let's look at who is actually holding the bag in a good way. Chapter 5. Ownership structure. We talked about the government giving money, but let's double-click on their ownership. The U.S. Department of Commerce is essentially a shareholder now. That still blows my mind a little bit.
It is fascinating. They own about 16.1 million shares directly, plus warrants for another 17.6 million. If you do the math, depending on if they exercise those warrants, the U.S. government effectively owns between 8% and 16% of the company.
Is that legal?
Common? It's legal, obviously, under the CHIPS Act. But it's rare in the U.S. We aren't France. We don't usually have state-owned enterprises. But this acts like a golden share. It signals to everyone else, suppliers, customers, other regulators, that this company has priority. If USR needs a permit fast-tracked or needs a rail line upgrade, having the Commerce Department as a major owner probably helps getting that phone call returned.
Who else is in there? Who are the institutional anchors?
You have Inflection Point, the group that originally brought the company public via SPAC. They doubled down in the PI-PE.
Yeah.
That shows high conviction. They know the company better than anyone. They've seen the dirty laundry, and they still put more money in. That's a good sign. Then you have the giants, BlackRock, State Street. They were already there, but as USR's market cap grows and it enters mid-cap indices, these passive funds will have to buy even more just to match the index.
And what about the insiders? The management? Are they selling into this rally?
We haven't seen filings yet for today, but generally the alignment is strong. The new investors came in at $21.50. That creates a solid base. There's no cheap paper floating around from a recent desperation financing. Everyone who just put money in is incentivized to keep the price above that level. It creates a very strong floor.
Okay, we've been very positive so far. $3 billion changes a lot of things. But I want to play devil's advocate. This is still a complex project. It involves chemistry, mining, factories, and global politics. Is not risk-free. Let's take off the rose-colored glasses.
Oh.
Chapter 6, Risk Assessment. We usually do a SWOT analysis here. Strengths, weaknesses, opportunities, threats. Give me the snapshot before we dive deep.
Strength. The $3.1 billion capital. That's the fortress. Weakness. Complexity. They are trying to do three hard things at once. Mine, process, and manufacture. Opportunity. The tariffs and the China-free premium. Threat. China retaliating and crashing the market.
Let's dig into that technical risk. We talked about heap leaching the rhyolite rock earlier. You said it's like a drip coffee machine. But you also said it hasn't been done at this scale for rare earths before. Why is that scary?
Because the real world is messy. In heap leaching, you are relying on gravity and fluid dynamics. You stack this crushed rock 20, 30 feet high. If the acid doesn't trickle through the rock pile evenly, if it creates channels where it rushes down one side and misses the pockets of ore in the middle, your recovery rates tank.
So you could spend the money to crush the rock and spray the acid, but the metal stays in the rock.
Exactly. If you recover 50% of the dysprosium instead of the 70% you modeled in your spreadsheet, your economics get worse fast. Or if the rock consumes more acid than you thought, if there's other stuff in there that reacts with the acid, your operating costs balloon.
How are they mitigating that? Are they just crossing their fingers and hoping gravity works?
No, this is where Barbara Humpton's digital twin strategy comes in again. They are collaborating with the Department of Energy's National Energy Technology Laboratory, or NETL. They are simulating the chemistry and the fluid dynamics virtually before they wet the rocks. They are modeling the flow. It helps, but until you do it in the real world at commercial scale, there is always a technical execution risk.
Then there are the macro risks. Inflation. We've seen construction costs skyrocket in the last few years.
Absolutely. Building a multi-billion-dollar facility in 2026 is expensive. Concrete, steel, skilled labor, it all costs more. If inflation spikes again, that $3.1 billion budget might get eaten up faster than they planned. And there is always politics. Administrations change. While defense is usually bipartisan, funding priorities can shift.
Yeah, the big one, the China price. What if China just decides to crush them? We know they control the market.
This is the classic threat. China could flood the world with cheap dysprosium tomorrow. They could drive the price down to levels where Round Top is unprofitable just to bleed USR dry. They've done it before to kill Western startups in the 2010s.
But you said earlier this time is different. Why?
Because of the iron fist of industrial policy, the U.S. government is now a shareholder. If China tries to dump prices, the U.S. government would likely intervene. They could set price floors, they could sign guaranteed offtake agreements at a fixed price for the military. The free market logic doesn't apply as much when national security is on the line. The government won't let their national champion go bankrupt because of predatory pricing. They have too much skin in the game now.
So the risk is there. Metallurgy could fail, costs could rise, but the safety net is thicker than it has ever been. Let's bring this all home. Chapter 7. Conclusion. We've looked at the pivot, the money, the tech, and the risks. Let's wrap this up with our bull and bear cases. If I'm an investor looking at this today, what is the dream scenario?
The bull case is that USR becomes the Lockheed of lithium, or the Northrop of neodymium. Execution is flawless. Stillwater opens this year and sells out every gram of magnet it makes. The mine comes online in 2028. The stock trades at a defense contractor multiple because the earnings are guaranteed by the DoD. In that world, you are looking at a stock price of $60 to $70 within a few years.
And the nightmare scenario. The bear case.
The money pit. The metallurgy fails, the acid doesn't work right on the rhyolite, the magnets from the factory don't meet the high specs for EVs and customers reject them, costs balloon. The stock drifts down, but, and this is key, because of the massive cash position, it likely drifts down to its cash value.
Which is what?
About $15 to $20 per share. It doesn't go to zero. They have too much cash for it to go to zero.
That's a pretty asymmetric bet. Upside to $70, downside to $15. So where do we land on intrinsic value right now?
When you take the cash on hand, which is about $17 per share, and add the de-risk future cash flows from the magnets in the mine, I calculate an intrinsic value today of between $35 and $45 per share.
And it's trading around $33, $34, so it's fairly valued, maybe slightly undervalued.
I'd say it's a solid entry point. The government put limits the downside.
So, final verdict.
My recommendation is BUY, but don't chase it if it spikes to $45 tomorrow on hype. Look for pullbacks. If it dips to that breakout level of $25, $28, that is a screaming buy. Accumulate it. This is a graduate. It's not a penny stock anymore. It is a critical infrastructure play.
USR has graduated. I like that. We have covered a massive amount of ground today. Mining geology, heap leaching, geopolitical chess, and billions of dollars in financing. It is dense stuff.
It is. But if you take one thing away, let it be this.
Uh-huh.
We are watching a fundamental shift in how the economy works. We are moving from free market purism to industrial policy.
That is the provocative thought I want to leave everyone with. We're leaving the era where companies succeed just because they're the most efficient, and entering an era where they succeed because they're the most necessary. If you own USR, you aren't just betting on a mine. You're betting that the U.S. military-industrial complex cannot exist without this specific pile of rocks in Texas. That is a very different kind of bet than buying Apple or Google.
Absolutely. The invisible hand is getting a lot of help from the Iron Fist.
And on that note, we will wrap up this deep dive. As always, thank you for listening, for learning, and for diving deep with us.
And just a quick reminder before we go, this analysis was generated by AI for educational purposes and should not be considered financial advice. Please do your own research before making investment decisions.
See you next time.